A mortgage-backed security, MBS, is a type of investment that is backed by a pool of mortgages. MBSs are created by packaging individual mortgage loans into a pool and then selling shares of that pool to investors. The investors receive a stream of income from the payments made on the underlying mortgages. In this video, we will explore the concept of mortgage-backed securities, how they work, and their role in the financial markets. Mortgage-backed securities are created by pooling together individual mortgage loans and then selling shares of the pool to investors. The mortgages that make up the pool are typically similar in terms of the interest rate, maturity date, and other key characteristics. The cash flows generated by the underlying mortgages are then used to pay interest and principal to the investors in the MBS. The investors receive a stream of income from the payments made on the underlying mortgages, which can be structured in a variety of ways to meet the needs of different investors. Mortgage-backed securities can be created using a variety of mortgage loans, including residential mortgages, commercial mortgages, and government-backed mortgages. How mortgage-backed securities work. The process of creating a mortgage-backed security begins with the origination of individual mortgage loans. These loans are then sold to a financial institution, which pools them together to create the MBS. The MBS is then divided into shares or tranches, which are sold to investors. Each tranche has a different level of risk and reward, based on the characteristics of the underlying mortgages. For example, some tranches may be structured to provide a higher yield but with a greater risk of default, while other tranches may have a lower yield but a lower risk of default. The cash flows generated by the underlying mortgages are used to pay interest and principal to the investors in the MBS. The cash flows are distributed to the investors in order of priority, with the most senior tranche receiving payment first, followed by the lower priority tranches. Mortgage-backed securities play an important role in the financial markets, particularly in the mortgage industry. By pooling together individual mortgages and creating MBSs, financial institutions are able to spread the risk associated with mortgage lending across a larger group of investors. MBSs also provide investors with an alternative to traditional fixed income investments such as corporate bonds or government securities. MBSs offer the potential for higher yields than traditional fixed income investments, while also providing a diversified portfolio of mortgages that are backed by real estate. In addition, mortgage-backed securities can provide liquidity to the mortgage market. By providing an additional source of funding for mortgage lending, MBSs help to increase the availability of mortgage loans for borrowers. This can be particularly important during times of economic uncertainty or when traditional sources of mortgage financing are limited. While mortgage-backed securities can offer investors the potential for higher yields and a diversified portfolio of mortgages, they are not without risks. One of the primary risks associated with MBSs is the risk of default. If a significant number of the underlying mortgages in the MBS default, the cash flows generated by the pool of mortgages may not be sufficient to cover the payments due to the investors in the MBS. In addition, mortgage-backed securities can be influenced by changes in interest rates, prepayment risk, and other market factors. Changes in interest rates can impact the value of the underlying mortgages in the pool, as well as the value of the MBS itself. Prepayment risk is another important risk associated with mortgage-backed securities. When interest rates fall, borrowers may choose to refinance their mortgages at a lower rate. which can result in the prepayment of the underlying mortgages. This can result in a decrease in the cash flows generated by the MBS, which can impact the returns for investors. Another risk associated with mortgage-backed securities is liquidity risk. In some cases, MBSs may be difficult to sell on the secondary market. This can result in a decrease in the market value of the MBS, which can impact the returns for investors. It is important for investors to carefully consider the risks associated with mortgage-backed securities before investing in them. Investors should also be aware of the fees and expenses associated with MBSs, as well as the tax implications of investing in these securities. Mortgage-backed securities play an important role in the financial markets, particularly in the mortgage industry. By pooling together individual mortgages and creating MBSs, financial institutions are able to spread the risk associated with mortgage lending across a larger group of investors. While mortgage-backed securities can offer investors the potential for higher yields and a diversified portfolio of mortgages, they are not without risks. Investors should carefully consider the risks associated with MBSs before investing in them, and should seek the advice of a financial professional if they are unsure about the suitability of these securities for their investment portfolio.